Two houses burned down in California in the same January week, same neighborhood, same square footage, same blackened foundation by Tuesday morning. The first family, household income around $85,000, calls their insurer. They get an adjuster 2 weeks later, a partial check 3 months after that, a depreciation dispute over their 14-year-old roof, and a letter informing them their policy won't be renewed for next year. A state regulator later finds 398 alleged violations in a small sample of similar claims. The exact phrase used by the California Insurance Commissioner is delayed, underpaid, and buried policyholders in red tape at the worst moment of their lives. The second family, household worth around $6 million, calls their insurer too. A dedicated adjuster shows up the next morning. Within weeks, they're offered a cash settlement up to policy limits. No obligation to rebuild on the lot, no fight over the roof, no non-renewal letter. Same fire, same state, same week. And somewhere else in this country, at the exact same time, a major health insurer is reportedly using an algorithm to reject medical claims at a speed that works out to roughly one denial every 1.2 seconds. That is not one industry, that is 4 industries wearing the same logo. My name is Nick, and I've spent way too much time staring at insurance policies, denial letters, and earnings reports that suggest insurance companies are doing extremely well, while you, statistically, are not. Today, we're walking up the income ladder one rung at a time and looking at exactly how insurance companies treat you at each level. Hit subscribe if you've ever opened an insurance bill and felt your soul leave your body, because the thing nobody tells you is this isn't one industry treating everyone the same. It's a sorting machine, and your bucket was decided before you ever filled out a form. Let's start at the bottom. I want you to meet Maria. Maria is not a real person, but she's not made up either. She's a composite of about 30 million Americans. Maria is 34, single, 2 kids, lives in a 2-bedroom rental in Phoenix, works as a tech at a regional hospital, takes home about $35,000 a year after taxes. Her credit score is 612 because in 2021 she had a medical episode, ran up some bills, and is still digging out. She drives a 2014 Toyota Camry she owns outright. Maria has never had an accident in her entire life. Here is what happens when Maria goes online and tries to insure that Camry. In most states, and I want to be specific about this, most states, insurance companies are legally allowed to charge you more for car insurance based on your credit score. According to the Consumer Federation of America, drivers with poor credit pay an average of around 115% more than drivers with excellent credit for the exact same coverage. Let me say that again. 115% more. Same car, same 0 accidents, same speeding tickets, twice the price. Your credit score, by the way, was originally invented to predict whether you would pay back a loan. It is now used to predict whether you will crash a car. The scientific connection between those two activities is 0. The connection to your premium is about $1,200 a year, and it gets weirder. They also charge Maria more because of her job. CFA testing in New Orleans found that GEICO would quote a factory worker without a 4-year degree about 91% more than they'd quote an attorney with the same driving record. In Baltimore, Progressive quoted a factory worker $1,818 a year. A plant supervisor, same address, same record, got quoted $1,362. The only difference was the job title. They charge her more because she rents. They charge her more because of her zip code. A 2017 ProPublica and Consumer Reports investigation found some major insurers charging up to 30% more in minority neighborhoods than in white neighborhoods with the exact same claim payouts. The risk was identical. The bill wasn't. And there's a special bonus charge for Maria because she had a coverage lapse last year. She couldn't afford insurance for 2 months when rent went up. So now there's a surcharge for being uninsured. They literally charge her a fee for once being too poor to afford them. Maria does not qualify for State Farm's good rates. She ends up at a company you've seen on a billboard near a check cashing place. The generals, the acceptances, the direct generals of the world. This is called the non-standard market, and it functions roughly the way payday lending functions, but for liability coverage, state minimum liability, the cheapest, weakest version of car insurance that legally lets you drive, runs Maria about $280 a month. The Camry is worth maybe $4,000. She is paying premium money for state minimum protection on a vehicle worth less than her annual premium. Maria isn't really insured, she's just legally allowed to drive. But wait, it gets worse because we haven't done health insurance yet. At Maria's income, depending on her state, she's either on Medicaid or scraping for a subsidized ACA plan. The bronze plan she can afford has a deductible somewhere around $7,500, which means until she pays that out of pocket, the insurance does not really do anything. She has insurance. Insurance as a verb, she does not have. She has a card. She also has a narrow network, which is corporate speak for most of the good doctors in your city don't take this. So when something breaks, and at $35,000 with 2 kids, something always breaks, she drives to whichever in-network urgent care will see her. She waits and she hopes. And then there's life insurance because the predators are not done with Maria yet. She watches daytime TV occasionally. She sees commercials all day for $1 a month burial policies aimed at people exactly like her mother. There's an active class action lawsuit against one of the biggest companies in this space, alleging they sell tiny burial policies to elderly buyers, ask vague health questions on the application, and then when grandma dies, conduct an exhaustive review of her entire medical history to find some unrelated condition, neuropathy, mild hypertension, and rescind the policy. So grandma paid premiums for years, the family gets a sympathy card and a refund, and somewhere a shareholder is delighted. The complaint is unproven, but it's the only product I know of that's advertised during Wheel of Fortune and litigated in federal court at the same time. That's tier 1. Every product costs more, every product is weaker, and on the back end, several of these products are quietly designed to fail at exactly the moment you'd actually need them. Let's climb. Let me describe your life, and you tell me if I'm wrong. You make somewhere around $80,000 a year. You drive something reasonable that you finished paying off 2 years ago. You have a 401k you contribute about 6% to, which everyone has told you is responsible. You have health insurance through work. You bought a starter home in 2019 before things got really stupid. And every 6 months, you get a renewal notice for your auto policy, and the number is a little higher than last time. And you don't quite know why, but you also don't have the energy to fight it. Welcome to the middle tier. This is the most dangerous one, because this is the tier where the system is most efficient at quietly extracting money from you while making you feel taken care of. Here's the thing about being middle class and insured. You have just enough assets to be worth suing and not enough to actually protect yourself. Your home equity is real. Your 401k is mostly shielded from lawsuits, but your taxable savings, your future earnings, wide open. If you, your spouse, or your teenager rear-ends someone on the highway and that person sustains a serious injury, modern jury awards for personal injury frequently exceed $2 million. Your standard auto liability tops out at, $300,000? Your homeowner's liability maxes out at maybe $500,000? Plaintiff's attorneys literally pull your net worth before deciding whether to sue you, and you, my friend, are the perfect target. Assets to take. No umbrella policy, cooperative. An umbrella policy that gives you another $1 million in liability coverage costs roughly $200 to $400 a year. $200. The same insurance company that mails you a calendar every December and a happy birthday email has never once aggressively called you to sell you an umbrella. They mailed you the calendar though, because the umbrella is one of the rare insurance products that's almost certainly worth the money for you, which is precisely why it is not the priority for them. What they will sell you is whole life insurance. Here's a number. Nobody puts on a billboard. A healthy 35-year-old can buy a 20-year term life policy with a $500,000 death benefit for around $25 to $35 a month. The same death benefit in whole life costs somewhere between $500 and $700 a month. That's roughly 15 to 20 times more, and that markup exists in large part because the agent's first-year commission on a whole life policy can run 70% to 110% of your first year's premium. The agent isn't lying to you. They are simply being paid an extraordinary amount of money to nudge you in a specific direction. And then there's health insurance at this income, which is where it stops being annoying and starts being personal. You have an employer plan, you have a deductible, you have an out-of-pocket maximum that last time you looked was a number that made you a little dizzy, and you have something called prior authorization, which is the polite industry term for the insurance company gets to decide whether you can have the treatment your doctor just ordered. ProPublica reported that one major insurer used an internal review algorithm so fast that, per their reporting, denial decisions were issued at a rate of roughly 1 every 1.2 seconds. One former company doctor described the process to ProPublica with the phrase, "We literally click and submit." The insurance company's official position is that overall claim approval rates are very high. The patient's experience is that the no, when it comes fast and with nobody human reading the file. And then in late 2024, the CEO of United Healthcare lost his life in a highly publicized incident in Midtown Manhattan. Investigators noted that the evidence left behind included words like deny and defend. When the company posted condolences online, the post received roughly 100,000 laughing emojis. 100,000. That is a real, undeniable metric of how public sentiment in this country feels about the human cost of health insurance denials. The middle class doesn't usually riot, they just stop sending get well cards. Now let's keep climbing. You're now making $150,000 to $300,000. You're a senior engineer, a partner track lawyer, a small business owner, a dual physician household. You have a real house. You have actual investments. You have a financial advisor whose name you can remember without checking your email. This is where the insurance industry starts being polite to you. Your auto insurance is suddenly competitive, your credit is excellent, your zip is desirable, your car is newer, you've never had a lapse. You get multi-policy discounts that feel almost generous. You probably have a primary care doctor at One Medical or somewhere similar, where you book appointments on an app and they remember your name and don't keep you waiting 45 minutes to be told you have a cold. You have a real PPO through your employer, with a real network and a real low deductible, which means you can actually see specialists without rehearsing a speech to the front desk about why your referral is taking so long. This is the tier where it stops feeling like a fight and starts feeling like a service. And this is the rehook, this is also the tier where the most elaborate sales operations live. This is the tier that gets sold concierge medicine memberships in the $2,000 to $5,000 a year range. Companies like MDVIP, where your doctor has a panel of around 600 patients instead of the 2,000 to 4,000 a normal primary care doctor has. Same person, same medical license, but the doctor has time for you. It's a real service. It is also functionally a tax on the upper middle class for the privilege of being treated like a human inside the same system that already takes your premium dollars. This is also the tier that gets pitched indexed universal life policies, IULs, which are basically whole life on steroids, marketed as a way to grow money tax-free in retirement using the magic of the stock market, but with caps. The caps are usually 8% to 12%, the floors are 0%, and the fees are creative. For some buyers in some situations, the math works out. For most, the math doesn't, but the commission absolutely does for someone else. And this is finally the tier where someone says the word umbrella out loud to you, usually a wealth advisor who's annoyed that nobody else mentioned it sooner. You get a $2 million umbrella for like $300. You wonder why nobody mentioned this years ago. Nobody mentioned this years ago because you weren't worth the conversation yet. Okay, one more rung. Let's go all the way up. Net worth above $5 million, income, let's say $750,000 and up. The official term is high net worth, which is itself a polite way of saying the customer the insurance industry actually likes. Welcome to the version of insurance that exists in brochures. At this tier, you don't buy homeowners insurance from the brand on the billboard. You buy it from Chubb, AIG Private Client, Pure Insurance, Cincinnati, Extayurix, names that don't advertise during football games because they don't need to. Your policy doesn't pay actual cash value or even basic replacement cost. It pays what's called extended or guaranteed replacement cost, which means if your $3 million home burns down and construction costs have spiked 40% because every other house on the street also burned down, the policy still rebuilds it. And this is the part that sounds invented, most of these policies include something called a cash settlement option. Your house burns down, you can just take the check up to policy limits and walk away. No rebuild required. Buy a different house, move to another state, retire, your call. That option does not exist on your aunt's State Farm policy. It just doesn't. When you make a claim at this tier, you don't get a 1-800 number. You get an adjuster's cell phone. The carrier sometimes sends out a guy with an infrared scanner before any disaster ever happens, just to make sure your house is safe. Your auto insurance covers the Range Rover, your spouse's whatever, the kids' cars, the boat at the lake house, and an umbrella that runs 10, 25, 50 million in liability. Because at this point, another 5 million of umbrella coverage costs roughly the same as a nice dinner. Your health insurance is whatever you want it to be. You have a concierge doctor who texts you back at 11 p.m. There are services in major cities, Solace Health is one, where for around $4,000 a year per person, you have access to private 24/7 urgent care with on-site CT scans and zero waiting room. There's a service called MD Squared that charges around $24,000 a year for the first family member, where your doctor's patient panel is around 50 families, 50, not 5,000, 50. And the wealthy don't really argue with prior authorization. If their doctor recommends something, they just pay cash. The insurance is just there for the catastrophic stuff. They have stopped using health insurance the way regular people use it and started using it the way large corporations use it as a backstop for events they hope never happen. Life insurance at this tier is essentially a tax product wrapped in a death benefit. A Senate investigation in 2024 estimated one specific high-end version was being used to shelter up to $40 billion from inheritance taxes. Same two words on the policy. Life insurance. Completely different product than what gets sold to grandma at the kitchen table. Now zoom all the way out. The same industry in the same year will quote Maria $280 a month for state minimum liability on a 14-year-old Camry, and quote a tech executive $280 a month for full coverage on a Tesla. We'll sell grandma a $10,000 burial policy and then exhaustively review her medical history to deny it after she dies and sell a hedge fund manager a $20 million policy that's functionally an estate tax loophole. We'll deny a cardiac procedure to one patient via algorithm and assign another patient an adjuster with a personal cell number. In 2024, the property and casualty insurance industry posted somewhere around $170 billion in net income and the largest underwriting gain in 4 years. The CEO of Allstate took home roughly $26 million in total compensation. The former CEO of United Health Group's parent company took home a comparable number. The industry spent over $100 million on federal lobbying, and the people getting denied, dropped, surcharged, non-renewed, and rescinded were almost entirely in the bottom 2 tiers. This is the part where I'm supposed to tell you what to do about it, and the honest answer is that individually, you can do a lot less than the industry would like you to think. You can shop your auto insurance every 2 years instead of letting it auto-renew because loyalty is structurally a tax. You can stop buying whole life policies sold at a kitchen table by someone whose commission depends on your signature. You can buy that boring $300 umbrella the day your net worth crosses into the actually worth suing zone. You can read your homeowner's policy and find out in advance whether it pays actual cash value or replacement cost on your roof, because that one sentence matters more than almost anything else in the document. But here's the only really useful thing I know. Insurance is not a relationship, it is a contract. They don't love you, they never did. The wealthy figured that out a long time ago and built their entire approach around it. They treat insurance like the cold, adversarial, transactional product it actually is, and they buy accordingly. They layer umbrellas, they pay H and W carriers more for products that pay claims. They run their insurance like a CFO. The rest of us treat it like a service from a friendly company with a mascot, and we get treated accordingly. The single most useful upgrade you can make in your financial life is to stop confusing the mascot with the company. Remember the two houses we started with? Same neighborhood, same fire, two different industries. The difference between them wasn't luck. It wasn't even fundamentally money. It was knowing early which industry you were actually buying from. I'll see you in the next one.